The new week starts on a positive note after the US equities posted their best weekly performance of the year. Last week, the US dollar is downbeat ahead of the US jobs data and the latest Federal Reserve decision due this week. The dollar yen, on the other hand, traded past the 160 level this morning on thin holiday trading in Japan, while the technology investors around the world are readying for Amazon and Apple earnings later this week as well. So welcome to a new week packed with economic data, corporate earnings, and events. This is Swissquote's Daily Market Talk. So just 1 week after posting its worst weekly loss over a year, and after a week of unfavorable economic data for both the US economic outlook and the Federal Reserve expectations, we actually saw the S&P 500 record its best performance since October 2023. So yes, the S&P 500 gained nearly 3% last week, while Nasdaq 100 gained more than that, as last week's sour combination of slowing US growth but rising inflation was offset by the better than expected earnings from both Microsoft and Google, and also a surprise jump in Tesla shares despite the fact that the company announced an earnings miss. And by the way, Elon Musk went on a surprise visit in China this weekend, and Tesla revealed a partnership with the Chinese equivalent of Google called Baidu on its maps, which was supposed to address a significant obstacle in the implementation of self-driving capabilities in China for Tesla. So we know that Elon Musk is now out and doing his best to convince investors to go back to funding Tesla. Let's see if his efforts will pay or not. Now, zooming out, Friday's higher than expected core PCE print in the US didn't weigh much on investor sentiment, as we discussed it before the data arrived. Most of the price action due to the inflation disappointment just happened the day before on Thursday's GDP report, and partly or fully explained why the market reaction to a higher than expected core PCE number from the US remained quite limited on Friday. So all in all, last week ended on a positive note. But again, the technology stocks did the heavy lifting in the US, because in the energy space, for example, the picture was much less bright on Friday, because both ExxonMobil and Chevron reported weak results in the first quarter of this year because of subdued natural gas prices. But ExxonMobil shares plunged as its results were worse than expected by analysts, while Chevron eked out a small gain as the 16% profit decline there was still lower than what analysts had penciled in. So it's all a question of expectations versus reality. And this week, two more Magnificent Seven companies, Apple and Amazon, are due to report their first quarter results, along with many other big and buzzy names, including MicroStrategy, Super Microcomputer, Qualcomm, MasterCard, and also Shell. So we will be watching and commenting on all of these. But beyond the US, the European stock markets also ended last week on a positive note. While in Japan, the Japanese Nikkei index extended its rebound on the back of a relatively dovish monetary policy statement last Friday from the Bank of Japan. Now, note that the dollar yen flirted with the 160 level this morning on thin market liquidity due to a local holiday in Japan today, and that's following the lack of a much expected intervention, or at least an announcement or a hint of an intervention from the BOJ last Friday. So the yen bears are out there testing the Japanese officials' patience and wondering why on earth no one says or does anything to stop the bleeding in the Japanese yen, as it has been promised by the officials and expected by investors since the 153 level was breached in the dollar yen. And the more the BOJ weighs, the more they risk losing credibility. And there is nothing worse for a central bank than losing its credibility. So at the current levels, an intervention from the BOJ could pop anytime, but the medium-term impact of a currency intervention is not a given, guys, if the intervention is, well, not backed by a more hawkish policy stance from the Bank of Japan, which, well, doesn't seem to be the case for now. Anyway, except for the Bank of Japan officials who see their bank holiday mood, well, dampened by the Japanese yen sell-off, well, the week starts on a good mood for most Asian equities. The Chinese CSI 300 index, for example, rallies above its 200-day moving average today, a rally led by the Chinese property stocks on speculation that the Chinese government will be unveiling more stimulus measures to tackle the deepening property crisis in the country. But more policy support from China is also needed beyond China's faltering property sector, because the latest data shows that the Chinese firm's profits fell 3.5% in March compared to a year earlier, and that's due to slowing exports and deflationary pressures, making the Chinese stimulus hope pretty much the main reason why investors would return to the Chinese equities. Elsewhere, the US dollar index starts this week under a decent selling pressure despite the pop that we saw in the dollar yen ahead of an important week in terms of economic data and events in the US. So we will be closely watching a series of jobs data from the United States and the Federal Reserve's latest monetary policy decision this week. Now, note that the Fed is not expected to make any changes to its monetary policy this week, nor in June, nor in July, nor in September, because to be honest with you, with such a visible U-turn that we see in US inflation dynamics toward the undesired direction, the Fed could or should not act anytime soon. Because if they can't pass this message this week, I would be very seriously questioning the Fed's credibility and its intentions. Therefore, I still see the risk in the US dollar tilted to the upside this week, especially if inflation elsewhere continues to fall, as it is the expectation for the Eurozone inflation numbers. So due this week, the Eurozone countries will be revealing their April inflation reads, and the core inflation in the Eurozone is expected to have eased to 2.6% from 2.9% printed a month earlier. And a softer European inflation will be yet another confirmation of diverging inflation dynamics between the US and the Eurozone, back an upcoming June rate cut from the European Central Bank at a time when the Federal Reserve is no longer seen cutting its own interest rates more than just once this year. And that divergence between the Fed and the ECB should limit the Eurodollar's upside potential into the 108 psychological level, which also includes the 50 and 100-day moving averages and the major 38.2% Fibonacci retracement on the year-to-date decline in the Eurodollar. In energy, well, US crude begins the new week with a minor slide, with hope that Antony Blinken's efforts to convince Israel to cease fire in Gaza, well, maybe could pay off this time, as White House announced just Sunday that Israel has agreed to hear out its concerns. But the barrel of US crude could see support near the $82 per barrel level, which is the bottom of the ascending channel base that has been building since last December, as besides the tense geopolitical landscape in the Middle East, while the reflation trade, the trade that relies on softer central bank policies, and also the narrow supply due to OPEC's efforts to cut supply, remain favorable for a further extension of the rally in the US crude. But note that a hawkish Fed message this week is actually a downside risk to this positive outlook, especially if the US finally convinces Israel to cease fire in Gaza. On the other hand, copper futures are extended rally on speculation that miners around the world will hardly meet the rising demand from green industries, and BlackRock sees another 20% rise in copper prices from the actual levels. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.